Hey folks, welcome back to the channel, and today I'd like to make a bull case for this year in 2023. This is a Seeking Alpha article where it talks about an indicator that has historically been very accurate. Now, past performance and relationships do not guarantee future returns, but this is an interesting indicator, so we're going to take a look at it today, and then you can make your own conclusions about whether you believe this or not. Now, this bullish perspective kind of goes against the video I put out a couple of weeks ago where I was bearish on the market. This is the S&P 500. I think it was right around here where I noticed stocks were going up even though there was bad news. So I said, maybe don't continue to invest right now, wait for a pullback, and then see what happens. And since then, the market has sold off because we are now in this bear channel going down. However, this warning was more of a short-term duration, but over a longer period of time, like 6 months to a year, I've mentioned late last year, and I'm going to reiterate it today in this video, I'm still bullish on the stock market, especially for 2023. And this is one reason why. It's called the January Indicator Trifecta, and now I'm going to explain what this leading indicator is telling us. So Jeffrey Hirsch is the author of Stock Traders Almanac, and he did all the research for this and basically concluded when there is a trifecta or three indicators being met around the transition of 1 year to the next, there is a really high chance that the market, being the S&P 500, will go up in that new year. So what are the three criteria? The first one is a Santa Claus rally, which means for the last 5 trading days of December, which are these 5 days here, and the first 2 trading sessions of the new year, the 3rd and the 4th in January, the stock market has to gain over these 7 days in order for the Santa Claus rally to be successful. So for this year, this did happen, so that one's checked off. The second thing is we need to see the first 5 sessions of the new year be positive overall. And again, that was the case this year in January. The S&P 500 gained by 1.4%. And then finally, the last criteria is that January has to be up as a whole. So this entire month of trading for this year did produce a positive return for the stock market with a gain of over 6%. So all 3 criteria are met, which means the January indicator trifecta is now in play, and we are likely to have a positive outcome for the year in general. Now, how likely is the market going to go up given that these 3 criteria are met? Well, since 1950, which is as far back as this research goes, the success rate, meaning a positive return for the entire year, is about 90%. So we can see all the years on the left here where the January indicator trifecta took place, how much the stock market gained during the Santa Claus rally, how much the market gained in the first 5 days in January over here, and finally how much the stock market gained in the entire month of January. You can see they're all positive, but in some months, January did really well, like double digits. And then the result we're looking at is over here on the right side. You can see it's pretty much all positive except for 1966, 2011, which is basically flat at 0.003%, and in 2018. But other than that, all 28 other times, the stock market was up for the year. So there was only 3 years where it was down. And this is the exciting part. The average stock market gain over all these years where the trifecta was in place was 17.5%. So that is much higher than the average stock market return of 8 to 10% a year. Of course, it definitely helps to get this number up when in 90% of the years the stock market happens to be up, which is a lot higher than usual. Now, here's what's even more surprising. If we add a twist to this, what if we have the January trifecta in place and also the previous year was a bear market? Well, instead of the 31 data points, there would only be 13. In other words, 13 times where we had the Santa Claus rally, the first 5 days being positive, January being positive, and the previous year being a bear market. Well, according to data gathered by Jeff Hirsch, the stock market has a 100% record of going up in these 13 times since 1950. So let's take a look at the data. These are all the 13 data points where the trifecta was followed by a bear market. And when we look over here, the returns are always positive. 13 times the markets are up, 0 times down. And the most surprising part is the average gain is 22%, which is like double what you would normally expect in an average year for the S&P 500. So if we combine this extra factor in there, then we can say that since 1950, this has never been wrong. It has been 100% reliable. But does that mean this year is going to be positive? Well, not necessarily, of course, because we don't know the future for sure. But given the historical patterns that we've seen, my bet is that we are going to have a very positive year, like probably more than 10% return in the S&P 500 just because last year the stock market was beaten down so much. And even though the economy is heading into a recession and things could certainly get worse before they get better, I just don't see a lot of things that can go wrong that would really push the market down a whole lot more than what happened last year. Now, even though I'm bullish on the market for this year, it doesn't mean that I want to buy all the stocks right now because the stock market does not move in a straight line. If I take a look at the S&P 500 on the weekly chart, you can see there is a lot of fluctuation. The end of this year would be over here, January 2024, and we started the year over here at the beginning of 2023. So we've had a good start for the year, but notice how we are pulling back now. And these wicks down on these most recent candles tell me that the market is fairly weak right now and might continue to go down over the next few weeks or so. But because it's not moving down as quickly as before, you can see over here, that is quite an aggressive move. Each one of these red bars represents a week. And over here as well, that angle is very steep. At least this time the angle is more like this. So it shows that on the weekly chart, the selling pressure is not as great as it was last year. So the market might go down, up, and then eventually finish the year maybe somewhere up here around 4,600 or so. That's just a guess. But I do think that the lows were reached last year. The market would have to fall substantially by quite a lot to go to a new low. A big test that could be coming up pretty soon is this downward channel right here. If we get a bounce off the top and head higher, then I definitely think we're in a new bull market. But if it drops through, then there is potential we could hit a new low, like around 3,200 later this year. But even if that happens, I think that would be a chance to buy the dip. Because if the January Indicator Trifecta comes true again this year, which would be 14 out of 14, then the market would need to finish the year at least at around 4,000. So if it drops, I think that is a good opportunity to start nibbling on the way down, and especially when it comes back up, I will certainly be more aggressive unless some really terrible event happens that I think might force the market even lower. And the other thing that I'm considering is to buy mid cap or even small cap stocks instead of large caps, because currently in mid-February right now, the forward PE ratio of the S&P 500, which are all large cap companies, is sitting at the same area that it was back in 2017, 2018 at 18 times. So 18 times is not very cheap for the stock market. However, if you look at the mid cap index, the forward PE ratio is only 14.5. So this is not only cheaper than the 18.1 of the large caps, but also relative to historical mid cap valuations, it's sitting at a pretty cheap multiple. You can see it stays above 14.5 most of the time. And when it does go down here, like last year and also in 2008, it was fairly short-lived. And especially now on the way up, this would be a really good time to get in because it's better to buy stocks with multiple expansion than to buy in on the downside where stocks are losing more and more value. So obviously there's going to be a lot of volatility and chop. You can see over here in 2011 and 2012, it wasn't just a smooth line going up. It was sort of this chopping motion, but eventually it did get up pretty high. So even if the earnings of companies don't change, when you have multiple expansion, and this eventually goes up to 16 or 17, even up here you can see to the 18 level, then that will be at a much higher price than what the index is currently trading at right now. So one way to invest in mid-cap companies is to buy an index fund like MDY, which is the Spider Mid-Cap Trust. As you can see, this one has been doing fairly well. It dropped from a high of about 525 down to the lows, and it actually double bottomed here in June and September at around the $400 level. So that's how you know there is bullishness. And also the green and blue lines, this is the 9 EMA and then this is the 21 EMA. Both of these are above the 50 EMA, which is also a very bullish signal. So if I were to put money into the market right now, I would seriously consider a mid-cap index fund instead of a total market or an S&P 500 large cap fund. Just because I think valuation-wise, mid-cap stocks are cheaper, which means they have more potential to grow and be more profitable in the future. So yeah, I just wanted to share the indicator with you guys. It has worked 100% of the time so far, but there's only been 13 data points, so you have to use your own judgment, like how much do you trust it? I think it's pretty valid, but I'm not going to buy call options or leaps on the index. Because one, just intuitively, we know that nothing is 100% going to be the case. There's always going to be some uncertainty in the markets. And two, even if we do get like a 10% or even 20% return this year, it's not going to be a straight line, so we'll probably get some dips along the way, and it's during those dips that I plan to do my buying. So I hope this was useful to help you make your own investment decisions going forward. Thanks a lot for watching, and I'll talk to you in the next one.